Thank you for joining us. I'm Arwen Thoman, and I'm the Student Loan Ombudsman here in the Massachusetts Attorney General's office.
And I'm Erica Harmon, the Deputy Student Loan Ombudsman.
Our office invited you to this webinar because one or more of your federal student loans is owned by a private lender. As a result, you're at risk of losing out on a historic debt relief opportunity. This opportunity is called the payment count adjustment, and through it, you can receive forgiveness of your remaining loan balance after your loans have been in repayment for 20 or 25 years, or for borrowers with particularly low balances in as few as 10 years. But to receive this adjustment and get credit toward loan forgiveness for all your past years of payments, you have to consolidate your privately owned federal loans into the direct loan program by the end of this year. Now, we sent each of you a letter because your Navient, Nelnet, or AES federal student loans were privately owned as of July of 2023. These loans must be consolidated into the direct loan program before the end of the year to receive and benefit from the payment count adjustment. In today's presentation, we're going to walk you through the steps that you need to take before the end of the year, and we'll also explain what you need to do in order to keep earning credit toward loan forgiveness. So to begin with, we need to explain how this historic debt relief initiative works. And to do that, we need to talk about income-driven repayment plans, because the way the U.S. Department of Education is going to get borrowers closer to loan forgiveness is through an adjustment to their income-driven repayment qualifying payment counts. The first income-driven repayment plan was created in the 1990s, but more have been created over the years. These income-driven repayment plans base your payments on your income and your family size. And perhaps most importantly, they offer forgiveness after 20 or 25 years of payments, and now for low balance borrowers in as few as 10 years. But the problem has been that in the 30 years since income-driven repayment was first created, only a handful of borrowers had actually received the promised loan forgiveness. And this abysmal track record was due to poor program design and just failed implementation by the student loan industry. To fix this and to restore borrowers' credit toward income-driven repayment forgiveness, the Biden administration is taking two important steps. First, it's conducting this payment count adjustment that will give borrowers credit toward income-driven repayment forgiveness for past repayment periods, even if they've never previously enrolled in an income-driven repayment plan. Second, it's created a new and much improved income-driven repayment plan called SAVE. As we'll get into, for many borrowers, SAVE is really going to be a game changer. But to receive the adjustment and to be eligible to enroll in SAVE, you have to consolidate some or all of your federal student loans into the direct loan program before the end of this year. So through the adjustment, you can receive credit toward income-driven repayment forgiveness for past repayment periods going back as far as July 1st of 1994 that would not otherwise qualify towards income-driven repayment forgiveness. This includes payments that you made on ineligible federal loan types, payments that you made before consolidating your loans, payments that you made before enrolling in income-driven repayment, any month in which you spent at least one day in repayment status will count. And forbearances that were 12 consecutive months long or that total more than 36 cumulative months, they'll also count. Finally, deferments other than in-school deferments that occurred before 2013 and certain deferments after 13 will also count, including economic hardship deferments. Just to try to clarify what won't count, periods of default and periods of in-school deferment will not count toward income-driven repayment forgiveness through the payment count adjustment, but all these other periods will. To benefit from the payment count adjustment, you have to consolidate any privately owned federal student loans into the direct loan program by the end of this year. And once you consolidate, the adjustment will be automatic, though it likely won't occur until the spring of 2024. Another thing to remember is that even if you don't reach the number of months that are needed for outright loan forgiveness through the adjustment, you can continue earning more months toward forgiveness by enrolling in an income-driven repayment plan, adding to the months that you receive from the adjustment. You should be able to see how many months you received through the adjustment in your studentaid.gov account sometime in mid-2024.
So let's get into the steps that you're going to need to take by the December 31st deadline. First, you're going to need to log in to your studentaid.gov account to review your federal loan types to see which loans you need to switch into the direct loan program through a process called consolidation. You already received a letter from us letting you know that you have some loans that need to be consolidated, but it's important to verify that you don't have others that also need to be consolidated. Second, you'll need to apply to consolidate all of your non-direct loans into the direct loan program. Third, if you also have some direct loans, you should evaluate whether including your direct loans in your consolidation could help you get forgiveness faster. This will be a consideration for those of you with loans that have been in repayment for different lengths of time. Finally, to keep earning credit towards IDR forgiveness, you'll need to enroll in an income-driven repayment plan like SAVE. So remember, the adjustment is only available until December 31st of this year. You must apply to consolidate your non-direct loans, including your Navient, Nelnet, or AES federal loans, by December 31st. So the first step in this process is to review your loan types to see which loans you need to consolidate. Federal loan borrowers can have several different types of loans, including direct loans, Perkins loans, and federal family education loans, often known as or showing up as FFELS or FFELPS. As you can see on this chart, only direct loans are eligible for the SAVE plan and the adjustment. You must consolidate any federal loans that are not direct loans, such as FFELS or Perkins loans, into the direct loan program by December 31st.
So to review your loan types, you're going to need to go online and navigate to studentaid.gov. Studentaid.gov is the U.S. Department of Education's main website for federal student aid, and it's your portal to access information about all your federal student loans and take certain actions with respect to managing repayment. It's worth noting that this is a completely distinct account from the online account you may have with the private company that services your federal student loans. To get into this account, you're going to need to log in with something called an FSA ID and password. If you don't have an FSA ID and password already, you should go ahead and create one. And it may take a couple of days for your account to be activated while the Social Security Administration confirms your personal information. We also see situations where it's been like a very long time since someone logged into the account, and if their phone number or their email address has changed, they might have trouble getting back in. In that case, you can call the U.S. Department of Education at 1-800-433-3243. After you've logged in, you'll see your account dashboard, which is what we're looking at right here. And as you can see, it shows your total federal loan balance along with any grants that you received. To find out what loan types you have, you're going to need to click on this View Details button. All right, so in this view, we've clicked the View Details button and scrolled down the page to the Loan Type section, which is where you'll see your loans grouped into several different categories. From this view, you'll be able to see whether you have an outstanding Perkins loan very easily because it's its own category. But to see your FFEL program loans, you have to expand each of these other loan type categories to see a breakdown of all the individual loans within the category. So in this picture, we've clicked on the subsidized loan category. And as you can see, there are multiple loans within this category. We're looking to identify whether there's an outstanding balance on a loan that is not a direct loan. In this example, there are two loans with outstanding balances. The first one in blue here is a direct loan, but the other is a FFEL loan. The FFEL loan will need to be consolidated. And keep in mind, you have to carefully review each one of these loan categories to see if any of them contain loan types other than direct loans. Now, we do want to take a minute to highlight some of the warning signs that may indicate that you have Pell Program loans or Perkins loans that need to be consolidated by December 31st, but it's not really a substitute for going into your studentaid.gov account. But hopefully just to motivate you, first, if most of you received a letter from our office like warning you explicitly that you had privately owned federal student loans as of July. Second, if your federal student loans are still being serviced by either Navient or AES, this is like a huge red flag that you have Pell Program loans. Now, while you can have Pell Program loans if you have another servicer, at this point, nearly all the federal student loans serviced by Navient and AES are Pell Program loans. Similarly, you could have a Perkins loan if you have federal student loans serviced by a company called ECS Heartland, or if they're serviced directly by your school. But there are other companies that service Perkins loans too. And just generally speaking, you can really only have Pell Program loans if you took out federal loans before 2011. And that's because the Pell Program ended in mid-2010. So, if you attended school before 2011, you could easily have some of these Pell Program loans. If you attended after 2011, you probably have direct loans and maybe some Perkins loans. Another indication that you have Fells or Perkins loans that need to be consolidated is if your federal loan payments haven't been paused, just automatically paused since March of 2020 when the pandemic began. So if you discover that you have these Pell Program loans, the second step is to consolidate your non-direct loans into the direct loan program. And you can fill out and submit a consolidation application in about 20 to 30 minutes on studentaid.gov. Under the Loan Repayment tab, you're going to need to select Consolidate Loans from the drop-down menu. After filling in some personal information, you'll be shown a list of all your federal student loans, and you'll be asked which loans you'd like to consolidate. You're going to need to consolidate all your non-direct loans. Now, some people may want to include their direct loans in their consolidation, and we'll discuss that scenario in a few minutes, but for the purposes of this example, we're just working on our Pell Program loans or non-direct loans. So make sure to select all your Pell loans for consolidation by checking the box next to each Pell loan. And if you want your Perkins loan to receive credit under the payment count adjustment, you'll need to consolidate it too. We will note, though, that once you consolidate a Perkins loan, it's no longer eligible for Perkins loan cancellation, which is a separate program from income-driven repayment, and it's available to borrowers in very specific professions, including teachers, nurses, and public defenders. If you're interested in it, you can learn more about Perkins loan cancellation on studentaid.gov. On the next screen, you'll be asked whether you want to delay processing your application. You're just going to want to go ahead and click Do Not Delay Processing. You'll next need to choose a servicer. And as part of this process, you'll be asked whether you're consolidating for the Public Service Loan Forgiveness Program, also known as PSLF. If you're not pursuing PSLF, you can choose No, and you'll be able to pick your servicer from a list. If you are pursuing PSLF, you'll be placed with Mohila, which is the current PSLF servicer. And for those of you who may be interested in more information about the PSLF program, we would suggest that you watch our other webinar on PSLF where we go over that program in detail. Now, as part of your consolidation application, you will need to choose a repayment plan for your new consolidation loan. And if you don't reach the required number of months for IDR forgiveness through the adjustment, you will need to continue earning credit toward income-driven repayment forgiveness starting in January of 2024. And for most borrowers, this is going to require making payments under an income-driven repayment plan. So select the box that says Repay based on my income. Now, in order to calculate your income-driven payments, the U.S. Department of Education is going to need access to your income information. And there's a nice new feature where you can authorize the department to just annually access your federal tax return so that it can automatically recalculate your payments each year. We definitely recommend providing this authorization so that you aren't burdened with having to submit your income documentation every single year by specific deadlines. So we suggest reviewing the authorization and clicking Approve at the bottom of the page here. After answering a series of questions about your marital status, family size, and income, you'll be shown your payments under the 4 income-driven repayment plans, as you can see here. Now, as a rule of thumb, SAVE will generally offer the more affordable payments, But if you have a particularly small loan balance, it is possible that income contingent repayment could offer a lower payment. And if you're consolidating Parent Plus loans, income contingent repayment will be the only income-driven repayment option available, unless you're able to use this double consolidation loophole that we'll get into later in the presentation.
We've been stressing the need to consolidate non-direct loans because these loans can't benefit from the payment count adjustment unless they're consolidated into the direct loan program. But if some of your loans have been in repayment longer than others, it may make sense to consolidate all of your loans together, including any direct loans you may have. This is because forgiveness will come faster on your more recent loans if you consolidate them with your older loans. For example, if you had a gap in enrollment between your undergrad and graduate school studies, consolidating all your loans together will speed up forgiveness on your more recent loans. So this third step is to evaluate whether this scenario applies to you and whether you should consolidate all your loans together. To demonstrate how this works, if your undergrad loans were going to receive 100 months towards IDR forgiveness through the adjustment, but your grad school loans were only going to receive 50 months, by consolidating them together, the resulting consolidation loan would receive 100 months, which will speed up forgiveness on your grad school loans. So next we want to talk about a few things relating to consolidation. And the first is that we hear from a lot of people who are worried about their interest rates increasing if they consolidate. So how this works is the interest rate on your direct consolidation loan will be a fixed rate equal to the weighted average of the interest rates on the loans being consolidated. And if that weighted average is between 1/8 of a percentage point, it will round up to the nearest eighth. So the effect of this rate increase, if there is one, is quite minimal and not something to be worried about. The weighted average takes into account both the loan balances and the interest rates, and it's never going to increase your interest rate. So for example, if you have a FFEL consolidation loan with a 4.3% interest rate, the interest rate on your new direct consolidation loan will round up to 4.375%. That is only a 0.075% increase. Also, enrolling in auto debit gives direct loan borrowers a 0.25% interest rate reduction. So if your interest rate does round up by consolidating, by enrolling in auto pay, you would more than offset that increase. You can see what your interest rate will be ahead of time by logging into studentaid.gov and completing just that first step of the consolidation application. It will calculate your weighted average for you. There's only one exception to this rule that we want to note. While it's somewhat rare, some FFELs are subject to special interest rate borrower benefit programs. So for example, a 1.5% interest rate reduction for making 48 months of on-time payments. Consolidating does end these special interest rate reductions. So there are two sort of special circumstances relating to consolidating that we wanted to mention. The first is if you've made more than 240 or 300 monthly payments on an existing direct loan, by consolidating that loan, you'll be giving up a refund of any payments you made beyond the 240 or 300 required for forgiveness. The U.S. Department of Education has made it clear that refunds will not be available for payments made on FFEL or Perkins loans. So this refund consideration only applies to consolidating direct loans. Second, if you have Parent Plus loans, consolidating them with your own student loans will restrict the entire resulting direct consolidation loan to the more expensive income contingent repayment plan, unless you're able to take advantage of a special double consolidation loophole to access the SAVE plan, which we'll discuss in just a minute.
So the final important step in all this is to enroll in an income-driven repayment plan. And some of you will have that opportunity at the time you consolidate, but if for some reason you don't enroll at that time or you're not consolidating, this is an extra step you're going to have to take. And this is because to continue earning credit toward income-driven repayment forgiveness, starting in January of 2024, most borrowers need to be in one of these income-driven repayment plans. And thankfully, there is a more affordable income-driven repayment plan called SAVE. The new SAVE plan is the most affordable income-driven plan in history. Rather than protecting income under 150% of the federal poverty line as past income-driven plans did, the SAVE plan protects income under 225%. And this means it will cut monthly payments to $0 per month if you make less than about $33,000 per year individually or under $67,500 for a family of 4. Another great feature of SAVE is that it eliminates any remaining interest after a scheduled payment is made. So for example, if your SAVE payment, if $50 in interest accumulates on your loan each month and your SAVE payment is only $30, the remaining $20 in interest just isn't charged. And this will prevent your loan balance from growing while you're in the SAVE plan. Also, married borrowers who file their taxes separately can exclude their spouse's income from their payments calculation. So some borrowers are going to want to give some consideration to changing their tax filing status next year in order to lower their monthly payments. The chart on the left here illustrates how SAVE payments change based on income and family size, and you should be able to use it to sort of be able to ballpark what your SAVE payments will be. Just to provide an example, someone with a family size of 3 making $60,000 per year would have a $34 monthly payment. And you can see here on the right the example of Alexander, a single borrower with no dependents who makes $38,000 per year. Well, he would have paid $134 per month under the old repay plan. He'll only have to pay about $43 per month under SAVE. And there are more improvements coming to SAVE in 2024. First, and perhaps most notably, payments on undergraduate loans will be cut in half. So those of you with substantial undergraduate debt can look forward to fairly dramatic reductions in your SAVE payments next year. Secondly, there will be a shorter forgiveness window for borrowers with low balances. If your original loan balance was $12,000 or less, you'll receive forgiveness after 10 years of payments instead of the traditional 20 or 25 years. This 10-year period will increase by 1 year for each additional $1,000 that you borrowed. So for example, if your original principal balance is $14,000, you would see forgiveness after 12 years. Unless your original balance was under $22,000, SAVE will offer forgiveness after 20 years, provided that you only have undergraduate debt. If you have any graduate school debt, the forgiveness timeline will be 25 years. Similarly, Parent Plus borrowers who use a double consolidation loophole to access SAVE will have a 25-year forgiveness timeline. If you're in the Income Contingent Repayment Plan, known as ICR, your forgiveness timeline will be 25 years, regardless of whether the loans were taken for graduate or undergraduate studies. But after making payments in ICR, eligible borrowers can switch to SAVE to access the shorter forgiveness timeline if they only have undergraduate debt. If you're in the pay-as-you-earn plan, known as PAY, the forgiveness timeline is 20 years, regardless of whether you had undergraduate or graduate debt. But very few of you will be eligible for PAY due to how old your loans are. Under the payment count adjustment, you'll begin earning credit toward forgiveness on the date your loans first entered repayment, and you'll continue earning credit toward forgiveness for each month in which your loan was in repayment or a qualifying forbearance or deferment. If you have a direct consolidation loan, you'll earn forgiveness beginning on the date the oldest original loan, one that went into the consolidation, first entered repayment. So again, most of you will be prompted to apply for income-driven repayment at the time that you consolidate, but if for some reason you're not consolidating, or if you get to apply at the time that you consolidate, you can apply for SAVE or another income-driven plan online at studentaid.gov/IDR. The online application is more efficient and it allows you to see your payments before you apply, which is nice, but you can also apply by downloading a PDF of the income-driven repayment application available at studentaid.gov/forms-library. All right, so we're going to try to get into the issue of income-driven repayment plans for Parent Plus loans. And before we get into this, we do want to try to just highlight that we have very detailed step-by-step instructions for how to use this double consolidation loophole that we're about to talk about. If you think that you can use this loophole, we highly encourage you to visit this link, mass.gov/AGO/Parent Plus, so that you can review our more detailed instructions. Okay, so unconsolidated Parent Plus loans, Parent Plus loans that have never been consolidated, they're not eligible for any income-driven repayment plans, including the new SAVE plan. But until July 1st of 2025, Parent Plus borrowers who have at least 2 federal loans can use a double consolidation loophole to access SAVE. For this loophole to work, you basically have to consolidate any Parent Plus loan that you have twice. You're basically trying to bury your Parent Plus loan 2 layers back in consolidations. Now, unfortunately, if you only have one Parent Plus loan or a single direct consolidation loan that paid off 1 or more Parent Plus loans, you're probably not going to be able to use this loophole. But in that circumstance, you can apply for the income contingent repayment plan, the ICR plan, after the Parent Plus loan has been consolidated into a direct consolidation loan. The problem with ICR is that it usually offers significantly higher payments than SAVE, but it is a qualifying repayment plan in terms of allowing you to continue to earn credit toward income-driven repayment forgiveness. To illustrate how the double consolidation loophole works, if you had 2 Parent Plus loans and consolidated each separately into 2 direct consolidation loans, and then you consolidated those 2 consolidation loans together, your final consolidation loan would be eligible for the SAVE plan. But it's important to remember that you only have until July of 2025 to complete all the necessary consolidations in order for that final direct consolidation loan to be eligible for SAVE. And to maximize the payment count adjustment, there may be advantages to getting it done before the end of this year. Again, we do want to just reiterate our recommendation that you review the detailed step-by-step instructions on this process located on our website at mass.gov/AGO/Parent Plus. So for everyone pursuing income-driven repayment forgiveness, be they parent or student borrowers, you need to be aware that the standard repayment plan for consolidation loans, the graduated repayment plan, and the extended repayment plan, these plans do not qualify toward income-driven repayment forgiveness. So, although the U.S. Department of Education is saying yeah, we understand that no one understood the rules before, we'll give you credit for payments you made under these plans in the past, that's all coming to an end in January. So if you're in one of these plans, you need to switch to an income-driven plan to continue earning credit toward income-driven repayment forgiveness come January. And enrolling in an income-driven plan does typically take a couple billing cycles, so you do need to get started now. All right, so we do run into people who say oh, but I can't afford these income-driven payments. And if you find yourself in this circumstance, there are a couple avenues to explore. I will note that this typically arises with higher income borrowers. First, you can ask your servicer to quote you a payment under a 10-year standard plan, which does count as a qualifying repayment plan for income-driven repayment forgiveness. I do want to sort of note that the 10-year standard plan is different from consolidation standard plans. Consolidation standard plans are typically much longer than 10 years and therefore do not qualify towards income-driven repayment forgiveness, but a 10-year standard plan will. And if you're fairly close to having the number of months that are needed for loan forgiveness, it's possible that you could pay under a 10-year plan for a while and still end up with a remaining balance to have forgiven. Another thing to potentially do is to consider changing your tax filing status to married filing separately if you're currently filing jointly with your spouse. If you do so, your income-driven payments will be calculated based on only your income, and you'll sort of have to discuss with a tax professional, sort of compare the savings on your income-driven payments versus what benefits you might be giving up by filing your taxes separately, if any. So before wrapping up here, we do want to try to take a minute to talk about just how we think about the decision that you were all facing in terms of whether to consolidate by the end of the year in order to receive the payment count adjustment. If you've been in repayment for nearly 20 or 25 years, consolidating into the direct loan program by the end of the year is almost certainly the right decision. If you've been in repayment for significantly less time or have a very small loan balance remaining, it might be harder to anticipate whether you'll actually receive forgiveness. The issue of whether you'll receive forgiveness really depends on how much you'll have to pay each month to continue earning credit toward forgiveness, and whether those payments will pay off your balance before you actually reach forgiveness. And since many of you won't really be able to tell exactly how much credit you'll receive through the adjustment, and since the downsides of consolidation are usually quite minimal, we typically suggest consolidating into the direct loan program before December 31st so that you can receive the adjustment and find out how close you are to forgiveness. Those of you who might be facing higher payments under income-driven repayment or the 10-year plan, you can then sort of weigh whether it's worth making those higher payments. The only really meaningful exception to all of this is that if you are going to lose a significant borrower benefit interest rate reduction that you have on your FFEL program loans, and these reductions are pretty rare. And frankly, like even if you have them, if you are going to receive forgiveness, it may be worth consolidating.
So we're just going to summarize the steps you need to take to benefit from the adjustment. The first step is logging into your studentaid.gov account to review your federal loan types to see which loans you need to switch into the direct loan program through consolidation. While the letter we sent noted that you have some loans that need to be consolidated, it's important to verify that you don't have others that also need to be consolidated. The second step is you need to apply to consolidate all your non-direct loans into the direct loan program. Third, even if you also have some direct loans, you should evaluate whether consolidating all your loans together, including your direct loans, could help you get forgiveness faster. And this is going to be a consideration for those of you with loans that have been in repayment for different lengths of time. And then finally, to keep earning credit towards income-driven repayment forgiveness, you'll need to enroll in an income-driven repayment plan like SAVE. Thanks for joining us today. We hope you feel more confident about what you need to do.